Okay, let's now welcome on board Kunal Tayal, Senior Analyst, India IT, Cement and Real Estate from BofA Securities, joining in from the sidelines of their conference. Kunal, hi, good to have you on the show. You track a lot of sectors, but first up, let me talk about the sector that's perhaps going to be most impacted or is already because of the global turmoil, and that's IT. Given the uncertainties around, what is your view on the sector? And from a valuation perspective, does it now appear reasonably priced at this juncture?
Great, absolutely. So I think firstly, answering on the business outlook side of it, look, our view on the business part is that companies have seen a little bit of deterioration since the announcement of the tariffs. The good part is that this is just a little bit deterioration. It seems to be much lesser than what was widely anticipated or viewed in the context of how the sector has performed in the last 2 years. That's number one. The second point is that the feedback also is that the uncertainty is here to stay. The movement you've seen on the tariff situation so far does not seem to be enough to sort of clear all of that away, and which is why the viewpoint is that the slight impact you're seeing is probably going to be around for another 2 to 3 quarters. So that's a view on the business side for the IT services sector. On valuations, look, I mean, in times like these when growth is slow, there's also the conversation around what will be the impact of AI on a go-forward basis. Very recently, we took a back to the basics approach on valuation, where our finding was that a DCF valuation for these names, if one assumes high single-digit growth rate for the next few years, is actually very supportive of a forward PE multiple, give or take, in the early 20s sort of a range, and the stocks are actually not too far from that. So I think, therefore, when we look at our picks in the sector, for us, this is really a combination of companies that can emerge as relative winners on the growth rates. Valuation across the sector seems to be in a pretty attractive zone.
All right. Hi, Kunal. Morning. This is Shrishti. And since you just spoke about the high single-digit growth rate for the sector for the next few years when it comes to the IT space, will that apply for FY26 as well? And for a sector as a whole, what's your commentary so far that you have been tracking? Will FY26 be much better than FY25, and will the margins expand?
Absolutely. So, that mid to high single digit growth rate is probably not something that the sector will see in F26. This year, of course, we're going to get brunt of the impact from the tariff related uncertainty. Companies that have already laid out a guidance for the year essentially are telling you that growth will be in the zip code of low single digit or maybe go up to mid single digit at best. So, about 3% or so is our estimate if we sort of coalesce the growth rate across the top names in the sector. The trajectory within that, of course, that we are hoping for is, as you come to end of the year and the uncertainty has reduced, is when you can start to see a build up or an acceleration in the growth rate as you sort of step into the early part of fiscal 27. To your question on margins, again, a thumb rule that we've seen play out in the sector is that when growth is on the lower side, lower than the 5% mark, margin management is a bigger challenge than in a typical year, because these companies do rely on managing the employee pyramid, which becomes a tough ask if the growth rates are low. And therefore, our view is that this year margin management also is going to be tougher than usual. Of course, there are companies within our coverage universe where we think that despite growth not being on their side because of company-specific reasons and the initiatives that some of these are undertaking, they should be in a position to expand margins at least a little bit versus F25 levels.
Hi Kunal, this is Nehi also joining in. While we are talking about the IT segment, let's talk about what the managements of individual companies had to make of the quarter gone by, because they were not very optimistic after their earnings for the quarter gone by. What is the sense that you're getting from the from your engagement with the managements with respect to the order inflows over the last couple of months? Has it deteriorated further, or do we have good days in IT ahead of us?
Right. So the commentary from the management teams, what we spot is broadly similar to the lines that they laid out in the April earnings season. So the description we've had is there has been pressure on some pockets of discretionary spends, especially in the so-called challenge verticals of automobile, CPG, retail, as well as travel. But then the management teams are also maintaining a stance that when it comes to cost takeout projects, operating model transformation projects, and in sectors like banking, financial services, energy, and utilities, they have pretty much seen business be as close to normal levels of performance. So, which is where I was sort of highlighting earlier that between management commentaries and some of the other checks / work that we have done, what we find is that there does not seem to be much of a step down versus the activity levels that there were in the month of March.
All right, but Kunal, let's shift focus from a sector that is impacted by the global factors, which is more domestic focus now, and that is cement. Now, if you look at the broader term trend, we have barely seen any price appreciation now that the competition seems to be intensifying and consolidation still being the name of the game. Where do you see the industry headed in terms of pricing?
Sure, absolutely. So it's been at least tough last 2 to 3 years on the pricing front. The couple of parameters that we are looking at, look, after the sharp downtick which is already played out, there are signs, and this is as recent as what we saw in the last quarter, which is the March quarter, that incrementally there is some uptick which is starting to come by, and some news flow has it that it might sort of carry forward into the ongoing quarter as well. So there are early signs that the pricing environment might be getting less intense versus how it has been. On a more sustainable basis, if one were to take a view, ideally the utilization rate for cement capacity in the country, in our view, will have to sort of hit the 75%, argue that a sustained trend in price increase could come by for the sector. So as of now, our view is that there is more like a near-term / opportunistic price increase that the sector is getting, which is good news after the trend of last 2 years. And of course, if the utilization rate is moving in the right direction, there's a chance that this could have a sustainable element to it as well.
Right. And Kunal, what about volume growth then? Top 5 players seem to be focusing on market share gains, but where does this leave the smaller and unorganized players in this market?
Okay, so volume was generally a challenge for the broader sector in FY25. It wasn't the best of years, but of course for F26, what we are looking at is a better trajectory. The feedback is that when it comes to capex as well as infrastructure related spending, even on the real estate side, the spend outlook in that sense, or the volume activity levels seem to be faring close to normal now versus a year like F25 when it was disrupted either because of elections and a few other reasons. Now, insofar as your question is concerned about the volume performance of the large cap companies versus the mid-sized and the unorganized players, I think here the trend has been very clear for the last 1.5 years that it is quite a bit of advantage in favor of the larger companies. Not just in terms of their distribution, but even in terms of their willingness as well as ability to sort of invest in smaller capacities that might not have been as profitable under a small setup. We've seen enough examples of larger companies taking those over and turning around the financial performance of a lot of these entities. So from our perspective, consolidation is something that could sort of continue in the sector.
All right, along with that, Kunal, now let's talk about the real estate sector, because we saw a boom for the luxury apartments in the COVID and post-COVID era, with price upticks still continuing. Where do you think that we are in the big fat real estate cycle, and how is the industry positioned at this juncture?
Absolutely. So I think one of the things that the property sector or the residential sector is potentially in year 5 of an upcycle. One of the things that we like about the current upcycle is the fact that as you've gone through this phase, demand has typically exceeded supply, meaning that, there has not been too much of a buildup of inventory. The participation of investors in the demand has been on the lower side than typical. Pricing has gone up, but again, it's still not gone up at a pace which makes housing unaffordable. And therefore, our view really is that even as you've had some serious compounding happen in the last 3 to 4 years for several of the large developers, from the current basis as well, there is a potential for the companies to grow bookings at a pace of about 10 to 15% for the next few years. And of course, our view is that because pricing has been quite supportive as well, the growth rate that we can see coming out of these companies, at least for the next 2 to 3 years, if not all the way up to next 5 to 7 years, could be ahead of the growth in bookings that they witness.
Okay, and also since you touched upon the point of demand exceeding supply coupled with increasing prices, is this trend expected to continue, and how is the premium and luxury housing versus affordable housing segment trend likely to evolve over the next decade?
Right, so for most cases, we would assume that this is a continuation of the trend that you have seen last few years. Like I said, the only delta for us is, because you've had a staggering growth transpire over the last few years, it is difficult to look at a 30-35% CAGR from here, and which is why we are more looking at 10 to 15%. Otherwise, on the ground, the demand for good projects seems to be high. Of course, on any top-down matrix that you evaluate India real estate / residential sector on, the demand should continue for the foreseeable future. To your question on luxury segment or the super premium segment, of course, this is basically what started or contributed in a big fashion to the first 4 or 5 years of the upcycle in the sector. Here on, we think that the luxury segment continues to do well, just that if we were to compare it to what's already gone by, there could be more of a balance between how luxury, the mid segment and the affordable segments participate towards contributing to the overall growth rate of the sector. It may not be as skewed in favor of luxury like it was in the first 4 years.
All right, Kunal, with this, we let you go on that. Thank you so much for taking the time out and speaking with us and giving us a sense on a couple of those sectors from IT to real estate and cement. But with this quick look at the markets we have.
If you like this video, then like, share and subscribe to ET Now.